According to Morningstar, the average investor underperforms the very funds they invest in by 1.7% per year. Not because the fund is bad, but because they couldn't stick with it. So what is that gap? It's about mindset. Today on Data Brief, we're digging into the psychological risks of investing. The emotional traps that quietly sabotage long-term returns. These aren't risks you'll see on a chart. They show up in fear, overconfidence, bad timing, and most investors fall into these traps at some point in their investing journey. Let's look at the data. Morningstar's 1.7% gap reveals a hard truth. The average investment isn't broken, our behavior is. This is called the behavior gap, the difference between investment returns and investor returns. The market might return 8% a year, but if you panic during a downturn and wait too long to get back in, your personal return might just be 5% or less. Why? Because you reacted at the wrong time. This isn't about intelligence, it's about psychology. So let's break down the 5 biggest psychological risks that cause investors to lose money and what they look like in the real world. But before I do that, these videos take a lot of time to write, create, and edit. If you enjoy them or have learned something from them, I would ask you to please subscribe. It helps me know that what we are putting out, the content that we provide, is helping you. Now, back to the video. Number 1, loss aversion. We feel losses twice as strongly as we feel gains. A 15% portfolio drop can feel like failure, even when it's completely expected. That pain causes some investors to bail or move to cash and wait it out. But markets often recover faster than we re-enter the market. And missing just a few good days, that can cost thousands of dollars over time. In 2020, the market dropped by 30% in weeks. Many investors sold, but the market fully recovered by the summer. Those who stayed invested or held on were rewarded. Those who left the market locked in losses. Number 2, recency bias. We give too much weight to what just happened. If the market's been ugly for 6 months, we assume the next 6 will be just as bad. If stocks are up, we think they'll go up forever. This causes investors to chase winners at the top and dump losers at the bottom. In 2021, tech stocks were flying off the charts. Investors rushed into growth funds, but by mid-2022, those funds were down by 30 to 40%. Most people bought at the peak, and they paid that price. Number 3, overconfidence. Overconfidence is sneaky. It makes us think that we're smarter than the market. We try to time the top, or pick the next big stock, or know when we should get out. The truth, almost no one does that consistently. But we believe that we can, and that leads to risk. In 2021, meme stocks like GameStop created overnight millionaires, but many stayed in just a little too long, chased the next hot name, and gave all of those gains back. Number 4, herd mentality. When everyone is doing the same thing, buying real estate, selling stocks, hoarding cash, it's hard to go against the crowd. But following the herd often leads to trouble. In the housing bubble of the 2000s, people bought second homes that they couldn't afford. Not because it made sense, but because, quote, everyone else was doing it. We all know how that ended. Number 5, short-term thinking. Investing is a decades-long game, but we're bombarded with headlines, alerts, and social media panic. That noise pulls our focus to the short term, and short-term thinking leads to bad choices. In 2022, bonds had one of their worst years ever. Many investors bailed just before yields rebounded and bond markets began to stabilize. They lost patience and they lost opportunity. So what can we do to avoid these traps? I think there's 3 things we should do. Number 1, automate your investing strategy. Automatic contributions and rebalancing remove emotion from the process. You don't have to decide what to do, it just happens. Number 2, write down your plan. A written investment plan keeps you grounded when the markets get messy. It reminds you why you're doing this and when to act, if ever. Number 3, talk to someone who cares. An advisor, a spouse, a friend who might be alongside you in your investing journey. Saying your fears out loud helps you from reacting emotionally. Markets don't need to beat you. Your own emotions will do that just fine. Psychological risks cost investors more than fees, taxes, or inflation, but they can be managed with structure, discipline, and self-awareness. So if you want better results, don't just look at your portfolio, look at your behavior. If you'd like to learn more about why individual investors lose when they invest in the market, click on the video that's linked here. As always, thanks for watching Data Brief. If this helped you reframe your investing mindset, tap like, hit subscribe and send this to someone who needs a dose of perspective. And as always, let's look at the data.